Welcome to Woods of Stardon. This is CH. I will be covering the Avantis International Equity ETF that has the Bloomberg ticker AVDE in this video, which is part of my Absolutely Biased Comments or ABCs series. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. This video is done as a follow-up request from a viewer's comment in my previous video covering the NEOS S&P 500 High Income ETF. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos, and I'll be happy to work on it as long as I can find enough information on the product. Avantis Investors was founded in 2019 and backed by American Century Investments or ACI. ACI is a US-focused investment management firm founded by Jim Stowers in 1958. ACI manages about $280 billion of assets through 1,400 employees as of June 2025. After both Jim and his wife, Virginia, were diagnosed with and recovered from cancer, they decided to establish and endow the Stowers Institute for Medical Research in 1994 as an independently operated and non-profit organization focusing on biological research on cancer, diabetes, and Alzheimer's disease. In order to ensure the ongoing running on Stowers Institute, Jim and Virginia established a unique funding model whereby Stowers Institute was made majority stakeholder of ACI, and in turn, ACI provides more than 40% of yearly profits to Stowers Institute as dividends. I think this is a really brilliant setup. Another key stakeholder of ACI is Nomura Holdings, who has 41% non-controlling interest since 2016. ACI and Nomura view this as a strategic relationship leveraging on each other's capabilities in their respective geographic regions. Avantis was created as a business arm to offer low-cost, actively managed products to investors. To do this, ACI hired Eduardo Repetto as Chief Investment Officer and Pat Keating as Chief Operating Officer for Avantis. Both Eduardo and Pat happened to be taking a break then after leaving Dimensional Fund Advisors in 2017. As a result, Avantis has a similar investment philosophy as Dimensional Fund Advisors, by relying strongly on academically supported financial science and consistent portfolio management and investment processes to generate higher expected returns than the broad market, or through a relatively low-cost structure. Many subsequent hires in Avantis have also had prior work experiences in Dimensional. Avantis has grown fast and today manages about $150 billion of assets with 32 strategies through US-listed ETFs and US onshore mutual funds. The AUM grew by 50% in just the first half of 2026, so there is definitely a lot of investor interest in Avantis products. The Avantis International Equity ETF is set up as a US investment company and is listed on the New York Stock Exchange or NYSE as an exchange-traded fund or ETF. Its Bloomberg ticker is AVDE and it is available for trading only in US dollars. The Avantis International Equity ETF lists 5 co-managers in its fact sheet. That is the same group of managers indicated for most of Avantis products. Avantis provides detailed bios for its investment managers in the website, so let's take a quick look. Eduardo, as mentioned earlier, is the CIO and heads the team on research, design, implementation of the investment strategies, and is listed as co-manager in most of Avantis products. He was the co-CEO and co-CIO in Dimensional Fund Advisors prior to Avantis, so he definitely has the experience and expertise to run this shop. Ted is a senior portfolio manager and focused on US domestic and international equity strategies in Dimensional. Matthew is the most junior in the team and was previously an investment associate in Dimensional, helping out on international and emerging market portfolios. Daniel and Mitchell are senior portfolio managers as well and focus more on emerging markets in Dimensional. It is a bit strange that the bios elaborated on their previous work experiences but does not specify their roles and responsibilities in Avantis. I can only assume they continue to specialize in the areas they previously excelled in, while working together as a team. This means Ted and Matthew likely have more responsibilities or impact than the others to the strategy of this ETF, given their past expertise in international equities. The Avantis International Equity ETF provides a simple investment objective and the investment approach in its fact sheet and website. The objective is to seek long-term capital appreciation, which makes it clear that this is not an income-focused strategy. The investment approach bullet points seem to be written more for marketing purposes, although there are some information here for investors to take note. The word international is an old term used in investment industry to reference geographic coverage and is created and mainly used by US investors, as opposed to domestic that refers to US equities. International therefore refers to a global ex-US geographic coverage, and for this fund, it is more specifically referring only to non-US developed countries. Given Avantis runs a highly similar investment philosophy and model as Dimensional Fund Advisors, we can see similar references to small caps, value bias, and profitability bias factors mentioned here that are the same key factors adopted by Dimensional. The ETF prospectus provides further elaboration on the investment strategy. The first line, as seen here, basically summarizes the ETF as a global ex-US all caps solution. Interestingly, there is no mention in the prospectus that the ETF focuses only on developed countries, which potentially allows the ETF to include emerging market countries into the portfolio in the future if needed. The prospectus then goes on to elaborate on the key factors for the stock allocation process that are high profitability as defined by adjusted cash from operations to book value ratio, and value characteristics as defined by adjusted book-to-price ratio. There is an emphasis on smaller market cap companies as the team believes there is a higher likelihood to find high profit value stocks in small caps rather than in large caps. Other factors such as past performance, liquidity, tax concerns, etc. may also be considered. Allocation weights of each position are determined using the relative market cap of the stock as the baseline, then adjusted up or down based on how relevant the stock meets the respective selection criteria. It is important to note that the stocks not meeting these key factors are simply de-emphasized or given lower weights, but not necessarily removed. The prospectus states that the ETF will invest at least 80% of assets in equities, implying the ETF can hold up to 20% cash in normal market conditions, which is way higher than most mutual funds and ETFs that typically only have max 5% in cash. More cash will obviously affect market capture or market participation, so I think the ETF would probably keep cash minimal in actual practice. While it makes no sense for the ETF to invest in bonds, the prospectus does allow for the flexibility as it makes no mention of such restrictions, and even allows the fund in adverse market conditions to adopt temporary defensive positions with no specific elaboration on what they might be. The ETF is allowed to invest in equities of different forms besides direct or common stock, including preferreds, convertibles, and derivatives. There is no mention of any restrictions for such exposures. While the ETF runs a non-US strategy, it is allowed to invest in depository receipts of non-US companies listed in US. There is no benchmark mentioned in the prospectus, but the fund webpage and fact sheet do indicate that the benchmark used is MSCI World X USA IMI Index. The prospectus does state that the ETF is actively managed and isn't meant to replicate the performance of any index. As investors, it only makes sense for us to expect the ETF to be able to outperform the benchmark over market cycle. The prospectus doesn't really talk about the investment approach, although we can refer back to the more generic investment philosophy of Avantis that was briefly shown earlier. Avantis essentially adopts a similar approach as dimensional fund advisors, that is to conduct active investing via systematic or quantitative modeling approach, relying on financial science and making use of computer models to help sift through data and create investment frameworks for the stock selection process. As Avantis is a newer and smaller setup, it doesn't seem to have much details in its systematic modeling approach in the form of written articles and white papers compared to what Dimensional has. The Avantis International Equity ETF was incepted in 2019, giving it almost 7 years of track record. AUM is at a very decent 18 billion US dollars. The benchmark of the ETF is MSCI World X USA IMI Index as mentioned earlier. We will want to see how the ETF differs from the benchmark, so let's first understand this benchmark index a little bit. MSCI is one of the most established equity market index providers globally. The MSCI World Index and MSCI ACWI or All Country World Index are probably the most commonly used global equity indices in the financial world. MSCI World Index covers about 1282 large and mid-cap stocks from 23 developed countries. MSCI ACWI includes another 1178 stocks from 24 emerging countries for a broader global coverage. Since these two popular indices do not cover small cap stocks, there are also the IMI or Investable Market Index versions. The MSCI World IMI adds 3877 small cap stocks from developed countries, while the MSCI ACWI IMI adds another 1839 small cap stocks from emerging countries. Investors looking for the broadest global coverage would therefore go for the MSCI ACWI IMI that has about 8176 stocks currently. Now, we are looking at an ETF that excludes the US market, which is the largest equity market in the world. So that reduces the universe quite a lot. The MSCI World X-USA Index has about 755 stocks, while the MSCI World X-USA IMI, that is the benchmark of this ETF, has about 2993 stocks. It is important to note that the ETF can invest in stocks not covered in the benchmark index, such as micro-cap stocks. We do, however, expect the ETF to stick with just developed countries. Otherwise, the ETF should use MSCI ACWI X-USA IMI instead for its benchmark. Let's go back to the ETF. The ETF fact sheet has benchmark data for easy comparison, so I'll be referring to that. ETF data is up till only June, however, so there will be small differences in the benchmark data. Here, we can see the ETF has nearly 3,300 holdings. That is about 10% more than what the benchmark has. Systematic or quantitative strategies typically have a very large number of holdings in the portfolio, as the computer models can handle them easily. Most of the holdings will, however, have very small percentage allocations in the portfolio that may not look too meaningful. In comparison, active fundamental fund strategies, on the other hand, will typically have about 100 holdings or less for the same market coverage, as these funds want each holding to have more meaningful weight and impact. The data here also shows the key factor biases in the ETF strategy, with smaller average market cap, value bias with a higher book-to-market value ratio, and profitability bias that is not so prominent here with a slightly higher profits-to-book ratio compared to the benchmark. Sector allocation shows some notable differences between the ETF and benchmark, with the ETF having meaningful overweights in materials, energy, industrials, and consumer discretionary, in exchange for underweights in technology, healthcare, consumer staples, and real estate. As there are no details on how the systematic models really work, I am not sure if these differences are mainly driven by top-down macro considerations or bottom-up stock selection and weight adjustments. Country allocations are, however, highly similar between the ETF and benchmark. Without US, Japan takes up the largest 22%, while UK and Canada are the next largest at 12% each. If we look at regional exposures, however, Europe in total is about 55%, with the broad Asia-Pacific region next at 32%. Top 10 holdings show some differences in names, again reflecting that the ETF is not just simply replicating the benchmark, but does have active adjustments in holdings weights. More importantly, it seems that the ETF has broadly lower percentage allocations to individual holdings to keep concentration risk low. As mentioned earlier, the Avantis International Equity ETF has only one US dollar share class that is listed on the New York Stock Exchange or NYSE, with the Bloomberg ticker AVDE. The ETF has a total expense ratio of 0.23% per annum. As this is an actively managed solution, this is considered cheap, especially if compared against typical equity mutual funds in the market. As per trading data provided in the ETF webpage, the ETF had been trading mostly at a slight premium in 2025. Given this is a global ex-US equity market exposure, the ETF is occasionally hit by significant market stress, leading to a larger premium discount gap. For example, in April 2025, when the equity markets had a small correction, the ETF traded in a slightly wider range of 0.55% premium to minus 0.27% discount over a few days. While this is not significant, investors who are looking to market time during higher volatility days should take note of this. The Avantis International Equity ETF states in the webpage that it has a quarterly distribution frequency. Although looking at historical distribution data available for download from the webpage, it seems that the ETF had been paying out semi-annual instead and only changed to quarterly frequency from 2026 onwards. Historical yield ranged from 2.2% to 3.8% on annualized basis, which probably isn't significantly different from the dividend yield of the benchmark MSCI World ex-USA IMI Index that currently has an annualized yield of 2.56%. There seems to have been some errors made when the frequency was changed this year, as the March payout looks way too low and was probably compensated in the June payout that looks way too high. The ETF has no income objective and therefore simply pays out any dividends collected from the underlying positions over time, which is what typical US listed ETFs tend to do. Given the yield is not too high, it doesn't significantly impact the NAV growth of the ETF, although over time it is still a meaningful amount. Investors do need to take note of US withholding tax on dividends of the ETF, if applicable. As the Avantis International Equity ETF doesn't disclose too much on its quantitative model, and the portfolio seems to be still quite similar to the benchmark index, we can only rely on performance comparison to see if the active management in the ETF is generating alpha returns. The ETF does nicely provide annualized performance data together with the index data for easy comparison, as seen here. On a total return basis, the ETF has done well and outperformed the benchmark index across all 1, 3, and 5-year periods. There is no calendar year data or comparison chart in the ETF webpage though, so let's use Morningstar charts to find out more details. The MSCI World ex-USA IMI is not a commonly used index, especially outside of US. I only managed to find one ETF that is IDEV from iShares tracking it. Looking at the Morningstar comparison chart here, we can see AVDE outperforming IDEV, showing success in its alpha returns generation. Most of the outperformance was generated in 2025 onwards though, as the two ETFs were performing near identical prior to that. So the next question for investors would be whether this is a good benchmark or market exposure to take. Let's first explore whether sticking to just developed markets or adding some emerging markets will do better. iShares has another ETF, IXUS, that tracks the MSCI ACWI ex-USA IMI that has emerging market exposures as well. Adding IXUS to the chart, however, shows that the performance differences between IDEV and IXUS have been rather minimal, showing that adding emerging markets exposure have not added any meaningful performance benefits in the past 7 years or so. There is another similar and also lesser used index called MSCI EAFE that excludes Canada as well besides USA. iShares again has an ETF XEF that tracks the MSCI EAFE IMI index that I have added into the chart here. We can see XEF is the worst performer, so the Canada exposures are definitely a positive performance contributor. But what are you missing out by excluding the US equity markets? Here, I have added instead the SPDR MSCI ACWI IMI UCITS ETF into the chart. That shows a global equity exposure without US is going to lose a significant amount of returns over time. If you are trying to avoid the US equity markets due to political reasons, or if you think it has become too expensive, I'm afraid this is not a good idea from a returns perspective. US equity markets still has the biggest impact in the global scene currently and has been leading the global markets in terms of returns direction, for better or worse. So skipping the US equity markets will have a big impact to long-term returns. On the other hand, a solution like AVDE will work out well if your portfolio already has too much US equity exposures. For example, through the popular QQQ or SPY ETFs or a handful of direct mega-cap stock exposures, and just want a quick and easy solution to get non-US equity exposures into your portfolio. As for competitor products, there are not that many active funds outside of US covering global ex-US equity exposure. The most obvious competitor would be DFAI from Dimensional. Given the Avantis team were mostly ex-Dimensional folks and they run a highly similar investment philosophy and systematic approach as Dimensional, we can see that AVDE and DFAI have had near identical performances over time. DFAI does have a slightly shorter track record because Dimensional was focusing more on mutual fund solutions before 2020. With that, let's summarize our findings. Avantis Investors is the active ETF business arm of American Century Investments or ACI, dedicated to provide low-cost active investment solutions. Avantis looks to be established and run by a strong investment team that are mostly from the reputable Dimensional fund advisors. Therefore, the two companies have high similarities in their systematic or quantitative investment approach. The individual manager bios elaborates on their past experiences in Dimensional, but does not cover the existing roles and responsibilities in Avantis. This is an active ETF with a pretty straightforward strategy of investing in global developed ex-US equity stocks through a quantitative-driven model that comes with clear stock selection criteria of market cap as well as value and profitability factors. The quantitative model is understandably proprietary and therefore no details are provided. This, however, limits the information available, especially with the portfolio construction process. as the portfolio is rather massive with well over 3,000 positions. The benchmark of the ETF is MSCI World X USA IMI Index. Given this is an active strategy, investors would expect the ETF to outperform the benchmark over time. The ETF has delivered a decent long-term performance, especially with clear outperformance versus the benchmark from 2025 onwards. Excluding US equity markets is, however, generally a bad thing with regards to long-term returns. The more appropriate usage for this ETF would be a quick and easy plug-in solution for investors' portfolios that have too much US equity exposures already. As with most US listed ETFs, this ETF is unfortunately available for trading only in US dollars. Therefore, Sing dollar investors and other non-US dollar investors will have to look for other solutions instead. In conclusion, the Avantis International Equity ETF is a decent performing and low-cost solution in the form of an active systematic ETF that covers developed all-caps equity markets excluding USA. The ETF is, however, not meant for everyone, and is best suited for investors who understand how to utilize the product in their portfolios. This concludes my absolutely biased comments on the Avantis International Equity ETF that has the Bloomberg ticker AVDE, and I hope it will help in your investment journey. May we all grow wiser and prosper.